Hi, everyone, and welcome to this wealthmanagement.com fast chat. Today, I'm pleased to be joined by Barry Martin, who is the lead portfolio manager for Shelton Capital Management's option overlay strategies. Barry, thanks very much for joining us.
Thanks for having us. Appreciate it.
Barry, today we're going to be making the case for covered calls. Okay, so we know that the derivative income investment space has seen explosive growth recently. I know assets in these kinds of structures, I think, have topped $80 billion this year, according to Morningstar. I think it was only $7 billion back in 2020. We know BlackRock has entered the space, Goldman Sachs, Morgan Stanley, they've all launched products here. What's fueling the demand, and why do you think this is the right strategy now for investors?
Yeah, well, I think a lot has to do with demographics. So, with people approaching retirement, we have baby boomers in a retirement looking for income. And now we have high interest rates. So you're really looking for something a little bit more. So that's why we're seeing a lot of people come to that strategy, I believe. Also, a couple other things. Options education has been huge. I've been running the strategy for over 25 years. And now you talk to your regular people and they're talking about options where that wasn't the case about 20 years ago. And obviously, costs have dropped dramatically. The strategy used to be pretty expensive. Option trades were very costly, but now they're cost effective. People trading options on their E-Trade accounts and their regular accounts, it's just becoming more popular. So we're starting to see people do it. But the main thing is income. And this is just another alternative way to generate income.
So we know investors are looking for that broader diversification through alternatives. We've all heard that. We know that the 60-40 balanced portfolio equity bonds for a lot of investors just probably isn't going to get them where they need to go. You've described covered call investing, I think, as the third slice to the traditional 60-40 allocation. What do you mean by that, and what does it add to the portfolio?
Yeah, I mean, people look back at 2022, and the reason why you had a 60-40 portfolio is that you had some diversification. But basically what happened is the returns came together. So 2022 was a pretty bad year for that portfolio. So now we're starting to see alternatives. So when we talk to advisors and clients, what they're doing now is maybe taking 10% of that 60% and 10% of the 40% and creating a new slice of the pie. And that's where the derivative income slice is coming in. You have a different return pattern. So it doesn't necessarily return like equities and it doesn't return like fixed income. So it has this different return pattern. And when you add it to that portfolio, you're actually reducing the overall risk. So, people do use it for income, but when you add it to one's overall portfolio, because it returns differently, it lowers your overall risk. So we're starting to see that more for diversification in one's portfolio.
Does it work in all markets, up, down, sideways?
It works really well in a choppy sideways market. It actually underperforms in an upward market. So if you're really bullish on the market, covered call writing is probably not appropriate for you. When you sell covered calls, basically what you're doing is you're owning the stock. And then let's say you own Apple at 190, but then you sell the right for someone to buy Apple off of you at 200, and they'll pay you for that right. So they might pay you $2 for that right. So you buy Apple at 190, you sell at 200s. If Apple goes past 200, actually 202, because you received $2 for selling that call, you've underperformed. So let's say this Apple goes to 240. You're out at 202, so you underperform. So it doesn't necessarily work in a dramatic upward market. You've made $12 on the trade, but you're not making the $52, right? But it really works well in sideways choppy markets. So if Apple never gets to 200, you're taking in that $2 every single time. But in a big downward market, if Apple drops to 150, your Apple will also go down to 150, but you receive $2 for selling that call. So any big swings in the market doesn't perform great. It really does well in that range bound type market that we've kind of seen in the last couple of years.
So let's dive into that a little bit and get a little bit into the weeds on a covered call. Is there, I guess a particular percentage of that's out of the money?
Yeah.
How far out are you going in terms of, expiration dates? What's the basic structure of these funds?
Yeah. So I think the main thing how we differ from a lot of people is actually we're doing individual calls on individual names. So once again, I mentioned Apple, we do Facebook, we do Google, Amazon. So we're buying those stocks and selling those calls on individual names. Some people, what they do is they take a basket of stocks and then sell an index call against that. We feel it's better to sell individual names, individual calls on individual names. Operationally, that's a headache, but we get better performance because we get more upside. So what type of calls we write? We actually sell calls that are out of the money because we want some of that return. We want some appreciation. And so we feel there's three ways to win the strategy. It's get some appreciation. So that's why we're selling out of the money calls. But we also like to receive the dividend. And then we also like to receive the cash flow from selling those calls. Like once again, that example of Apple, we're getting that $2. So those are the type of stocks or options that we sell. We also tend to sell shorter dated calls. There's a thing called time decay. And so time decay really kicks in when you're selling an option at a 20-day mark. So the options we sell are typically around 40 to 50 days out. So it's slightly out of the money. And also maybe, a month or 2 months out of the money to take advantage of that time decay and really get a lot of those sales in over the year.
And any thoughts on educating or how advisors can educate clients about it? I'm sure there's a lot of material out there. I'm sure you all have a lot of material.
Yeah, there's a lot of material out there. And I think the best thing is just communication with the clients. Here at Shelton Capital, I like to say, we're not too big, but we're not too small. So, we have a lot of phone conversations with advisors and the end clients, explaining the strategy, explaining the benefits and then the pitfalls of it. And I think education is the best thing for clients and their advisors. And once they understand the strategy and then how the market performs, that they'll get a feeling of how it goes and the benefits of it.
Well, that's fantastic. And I know you guys do a great job of explaining this stuff. So Barry Martin, thanks very much for joining us on this wealthmanagement.com Fast Chat.
Thank you.